we talked about buying a stock, and just kind of quickly review. We select from scans of a company that's doing well, making money. We understand the company, and we're comparing the competitors. That's great. We've gone through our charts. We're looking at the chart. We're finding an uptrend. We're drawing our trend lines, and we're buying on pullbacks, which are retracements, or we're buying on breakouts, a little bit more aggressive. We just talked about selling, which is when to exit a position for a profit when it breaks under a trend line or hits your consensus analyst price target, or just a round number. That's a sell. But let's talk about managing positions. What happens between the buy and the sell? That's called position management. And we'll talk about that now. It's like a store managing inventory. So a store, whatever it sells, hamburgers or whatever the case is, iPhones or phones for that matter, it has to buy them. And of course, when the customer picks the customer picks the inventory up, the item up, they check out and they go. The item has been sold. Hopefully at a profit. Hopefully the store does not have to discount their item, and they can use the profit to buy more inventory. So this is just simply a stock going into our portfolio, our store, and then selling it hopefully later at a profit. And of course, don't just, and this actually happens, not literally, there's no one that sticks their head in the sand, but when you buy a stock, when you just buy a stock at that point, you don't just let it stay there in your portfolio. So trade management is active management. And so that's a key phrase we like to use when you're planning your trades. You just watch them as they go. Maybe you set alerts. You're on guard for new or surprising information. We'll talk about that shortly too. So just kind of to review, if you talk about the 5 steps to a position, do your research, find those good companies, find the uptrend, buy on a pullback or a breakout, manage your position, exit your position. 2 additional things you can do during the management phase. Really important here. We can't just, again, hope everything works out. You can actually do some things to make more money, especially if a stock is continuing to trend up. Remember on the other examples, we saw all those other spots where the price touched a trend line? You can actually buy more shares and add. We call this adding to existing positions. Or if you're a little bit risk averse, the trend line is going to hold, you can buy, instead of 100 shares, buy 50 shares or 25 shares. And as the price does what you thought it would, as it trades up, it comes back down, you can put your other 50 shares or the full position, full size, back on. That's a position management where you're adding to what you already have and what's working. Alternatively, you can take some money off the table, not your whole position, if the price becomes, remember I said way, way, way overextended? We didn't really define that, and you really can't define that as easily. So if the price goes way, way, way up, and you make a really good profit, you don't have to sell the entire thing. You can sell what we call partial profit, which is maybe 50 shares, or half of your position, or 2/3 of your position, and we would use the term, let it ride. Some poker games that use that term, let the rest ride. It's free money, you've made it, in the sense of that investment. So you can remove half or whatever percent at a level, maybe the analyst targets, but maybe when that happens 6 months later, the analysts have raised their targets because the price is high. Either close the whole thing, close some of it, or just keep the whole thing on and raise your price target. You can do that. But if you're in a winning position and something really, really bad happens, something major changes, the CEO resigns or passes away or dies, that actually happens. May or may not be a good thing. Sometimes a bad CEO, that's why you can't just say when a CEO resigns, it's a bad thing. It could be someone that was bad that was kicked out. And from that point on, the stock could do better. But more than not, it's a sell first, ask questions later, or sell this stock and go to something else when something really bad happens. the company significantly misses earnings, something really bad happens with the market, it falls behind competitors, something really bad changes, or a major negative event happens. I chose the BP oil spill example just for teaching purposes. Same thing, sell first, ask questions later. And in this case, when something bad happens during your position, don't wait, because if it's really bad, and if it actually does sell and trades lower, it will break your trend line 20% lower, 50% lower, or 15%, whatever the case is, and you'll lose that money. We don't want that to happen. It'll wipe away your profit. Go ahead and something really bad happens, sell that day. It's an emergency action. It doesn't really happen that much, but it does. And again, I chose this example from the British Petroleum. BP was most famous for the, most known, I guess, for the oil spill in the Gulf of Mexico. It actually started in April 20th, 2010. This is arguably, at that time, a strong stock, better than the competitors, good earnings, all those kind of things. It is, forget this, we don't know what's going to happen. We can't. But it is uptrending. There are multiple buy signals. There's even a breakout buy a few times, etc. We start to break the trend line here, which is not relevant to this oil spill, but still. In 2010, the trend line breaks. We'll go ahead and sell the position here. But if you, for whatever reason, continue to hold BP, and as the oil spill happens, actually the price was at the high, it was at $60 per share. And it started to trade lower, really started accelerating the sell-off. It was like, oh my gosh, get me out of this thing. It's gonna, they're gonna get sued, which they did. They have to pay lawsuits and remunerations, and just bad publicity, and all these sort of things that happen. And of course, that's what happened. In the matter of about 2 months, the stock price was cut in half. From 60 per share on the day that the oil spill began to occur, and the news, BP is a part of it, they may be culpable, we don't know. It's what I'm saying. In an emergency situation, sell first, ask questions later. If you held this, there's a trend line right there, and if it'll come back, it's okay, nothing bad. 60 per share, 30. Your 1,000 account now is $500. Next question.
So when you see something that, obvious that it's going to go down, who's going to buy?
That's why it goes down so quickly, because we don't say there's an absence of buyers, but the buyers, they essentially evaporate. They don't exist. But like the house, if people are bidding for a house and all of a sudden it's determined that there's a sewer leak or some sort of something has happened bad about the house, while it's being sold, it's going to have, two things happen. No one's going to buy at the price that was agreed upon at $200,000. No one's going to say, okay, I want this house with a nuclear plant. It's going to be built in the backyard, or some nuclear fallout, whatever the case, whatever the bad news from the house was, or a prison will be built next door 2 years from now. Okay, well, new information. I don't want that house. And what's going to happen for someone to buy the house? It has to drop precipitously from 200,000, 180,000, 150. Any takers, any buyers? No. You have to keep essentially auctioning or pushing the price lower to get someone to say, "I'll take it at $30,000, and maybe I'll, hold whatever the case is." But somebody will step in at some price, but in aggregate. Same thing with prison being built, or nuclear something happening to a house, or something about a house that's haunted, officially haunted, or whatever the silly example is. But in case, yes, really aren't enough buyers to stop this cascade, this avalanche, or this very rapid trend where people move in herds, and that happens in the downside too. The one final thought for management is, if you're like most people, myself included, we all do it, you'll find every excuse in the book. Even with your BP example. Oh, well, look, it's bouncing here. Oh, it's bouncing there. And, well, it can't be that bad, right? etc. 50% decline in a month is pretty bad. So you'll find every excuse in the book to hold on to a losing trade. There's actually research, we won't go into it now, but people actually will feel more pain from losing than the pleasure they feel with a gain. So they will do whatever is in their power to do to avoid an actual physical loss. It's just paper money, right? Well, if you're paper trading, if it's real money, it's just a pretend loss until you actually sell the position. Then it's real. Then you've lost the money and it doesn't come back. So people do hold on. Don't do it. Sell your position. Move on. Don't play games. Don't gamble.
Don't with a small loss, which is guaranteed. You can take that position, you'll lose
$100 or whatever the case is. But if you gamble and play, maybe the 100 becomes 0 and it comes back up. Okay, cool. What if it becomes 500? By stop losses, we would stop that from happening.
Not only lose money, you'll also lose time. In those 2 months, on BP is an extreme example for sure, but in these 2 months, the price was cut in half.
That's 2 months. You could have been buying a stock on a pullback. You could have had these 2 months, or even these 2 months. You could have had that. You didn't. You held and hoped and prayed that the price would come right back up and be okay. In this case, you weren't. Investors weren't, and this is why we sell first, ask questions later, and don't let a small loss morph into a huge one.